Hello, ladies and gentlemen. I hope you're fine wherever you are. I am your number one Acca tutor, Mr. Jerub Tubkulu, and we are going to continue from where we left. In our previous video, we talked of relevant costing. All right, and in this one, we are going to get a step further into the area of net present value with regards to working capital. Okay, working capital. The idea here is that we all know that working capital is resident in our net present value computations or questions. Okay, the working capital is something that you need to be comfortable with because it is going to come in almost every exam. All right, so we're going to do two examples. All right, the first one will be where the working capital is just required at the start of the year and then getting released at the end of the year, which means that the working capital would be an outflow at the beginning of the project or of the project's life, and then it is going to be released or it is going to be recovered or it is going to be an inflow, excuse me, at the end of the project's life. All right. Now, when you're talking of working capital, ladies and gentlemen, we mustn't panic. Okay, we must not panic. It is just the same working capital we know. Okay, we are talking of issues to do with things like inventory holding or inventory uh, management expenses, rather. Okay, or the cost of carrying of inventory or raw materials, and the financing of receivables resulting from sales, something like that. Okay, so we are not talking of something new here. We are just that working capital for our day-to-day running of the project. Okay, so that is that, because you discover that it's not only about purchasing a new machinery and then you leave it to the project. No, the project would need some liquid cash here and there that is going to be used to ensure that it is running smoothly. So in most projects, this cash requirement would be only at the start of the year of the project, and then the project will run as it is. So then you require some other payments, maybe on an annual basis, or you just don't have to input anything, right? You just have to pay once at the start of the project, and then at the end of the project, it is assumed that you have to recover that money back. All right. Then in another scenario, you will see that the requirement would be dependent on the percentage, on the revenue accumulated. Okay, so if you make some revenue from the project, you then have to multiply a certain, you know, percentage on the of that revenue as your working capital. All right, the assumption will be the working capital requirement in that particular year would be equivalent to a certain percentage of revenue. All right, so let us cross that bridge when we reach there. For now, let us look at this particular example and see if we can make sense out of it. A machine costs $100,000 to purchase. In addition, a further $20,000 working capital will be required at the start of the project. The project is expected to last 4 years and to have a scrap value of $20,000 at the end of its useful life. Net operating cash flows are expected to be $30,000 per annum for the first 2 years and then $40,000 per annum. Excuse me. For the first 2 years and then $40,000 per annum for the following 2 years. All operating flows are to be assumed to occur at the end of year. Calculate the net cash flow for each of the years in question. You are not required to discount or arrive at an investment decision. Okay, the requirement here is that you just have to stop when you reach the net cash flow stage. All right, we'll tell you or we'll show you what that stage would be like. So for now, let us open our spreadsheet and do the computations. All right, let us try to open a new sheet here. Wow, that's nice. All right, now as in any of your NPV computations, you just have to have an NPV table or template in the back of your mind. Okay, just have that. You must be able to memorize that. Okay, and you master the issue. So in our table, we start with the years. Okay, let's start with the years. Okay, yeah, we start with year 0, year 1, year 2, year 3, and this one was a 4-year project. Okay, then I advise sometimes it's just good practice to just start with your initial investments. Okay, sometimes it's not. Yeah, you just have to judge with the type of question. Okay, because in other big questions, then you may start with things like the revenue, the cost of sales, and so forth. Okay, but in this case, such has been done for you. You are told of the net operating cash flows only. So no need to start with the sales and so forth. All right, so our initial investment in this case was the machine. Okay, the machine it is bought in year 0 at a cost of 100,000. Right, so we can safely say machine, you can put your $sign there. Sorry. All right, so at the start of the year we buy a machine for 100,000. So we now know that this in dollars. All right, and because it is an outflow, okay, you can just put brackets or just a negative sign here to show that this is sorry for that. All right, okay, okay, and then that's the initial investment. Then we can look at things like the working capital, because we are told that in addition a further $20,000 working capital would be required at the start of the year. So you just say your working capital. Okay, working capital, and it is required at the start of the year. So again, that's 20,000. All right, you did that. So as you know, this is assumed to be recovered. Okay, because the project is going to cease, and we are not told that there is need for replacement of the machine at the end of the project. So we just assume that this working capital is going to be recovered. Okay, but in most cases, that is in most exam questions, okay, the examiner has stated within the question that the machine in question will be replaced at the end of its useful life. Okay, so in that case, this implies that the product will still continue to be made, and that therefore the working capital will still be needed. All right, so if the machine is said to be is required or is to be replaced, then we have to be careful there. It means that the working capital should not be released, but it's going to be required constantly. All right, but in this case, we are not told anything about that, so we have to recover. Okay, we should recover the working capital, so we are going to have a positive 20,000 at the end to show that we are recovering. It is an inflow. All right, let's now talk of the residual value or the scrap value of the machine. We are told that at the end of the project, the machine will be disposed of or would have a scrap value of 20,000. So we're going to have at 20,000 here. Positive because it is an inflow. Excuse me. And then let's talk of the operating cash flows. Okay, operating flows. These ones, they start in year one. Okay, for the first 2 years. So from year one and year two, I mean between year one and year two, we are going to have, in each of year one and year two, we are going to have 30,000, 30,000, and then in year three, we will be having 40,000, and in year four, 40,000. That's the idea. Therefore, we then arrive at what we call the net cash flow. Okay, the net cash flow stage, the net cash flow stage, or net cash flows. All right, so these are the cash flows which require discounting. So from this stage, from the net cash flows, then you have to put your discount factor at whatever percentage, then you come to the PVs. So the question says just stop at the net cash flow stage. So if you are stopping at the net cash flow stage, then flow with me, just flow with me. But let us do some little bit of rounding, of formatting. You can just put our underlinings here, and I hope we have underlined. Yes, then you can just double click here to enlarge our cell for column A. All right, and so if you add, you can see that this one should be some these. Okay, you get that one here. You just have to, you can as well just copy and paste, or just type it to save your time. So that's 30,000. Here it's 40,000. Here you can as well use your sum function, then you add up everything. That's it, and then you are home and dry. These were the cash flows, the net cash flows we were looking for, and you can as well do your formatting. Now let us look at the other example where we say that the working capital is going to be required over the project or throughout the life of the project. Okay, and then will be recovered at the end where possible. All right, so let us look at that question and see if we can make something meaningful out of it. A machine costs 15,000 and is expected to last for 4 years with a scrap value of $2,000 at the end of 4 years. The sales revenue and operating costs for each of the 4 years have been estimated as follows. So we have got year 1, year 2, year 3, year 4. All right, so in this case, the examiner is actually telling us explicitly that he wants us to use, to follow the format here. We start with the sales revenue, operating costs, and we move on like that until we reach the point of net cash flows. Okay, so our working capital of a working capital of 10% of the year's revenue is required at the start of each year. Okay, so that is it. All right, so let us see what to do. Let us open our spreadsheet and see. All right, so you can just say question 2. Okay, we have our NPV. We can just do our NPV table as usual. Year 0. Remember, these are the years. years: year 0, year 1, year 2, year 3. Hey, what's going on? Year 3, year 2, year 4. Okay, we start with the revenue. Okay, the revenue, we are told that in the first year we are going to have 5,000 revenue. Second year we're going to have 11,000, 8,000, 9,000. So 11,000, 8,000, 9,000. Okay, and then we are told of the operating costs. The operating costs, ladies and gentlemen, are operating costs 2,000, 2,000, 2,000. So there are 2,000 throughout, and we are not told of any increase during the year. So that's 2,000, 2,000. All right, but remember, these are negative cash flows, so there is need for us to put them in negative for their outflows. Okay, then we then have to consider other cash flows like the scrap value of the machine. So you can as well start with the machine's value. The machine, in this case, the machine was bought for 15,000, so that's a negative 15,000. Then you come here and say scrap. The scrap value is going to be in year 4. This machine is going to be sold at $2,000, so that's a positive $2,000. And then working capital, this is where I want you to see working capital. Okay, you can come here on this side and say workings. Okay, 1, working capital. Working capital, you've got years. We've got year 1, year 2, okay, year 2, year 3, year 4. And we've got the values 5,000 for revenue, because we are told that this is going to be dependent on the revenues in that particular year. So 8,000. Okay, you can as well say revenue. And 9,000. Okay, and we are told that this is 10%. All right, 10%. All right, but it is 10% of the incremental revenue. Okay, 10% of the incremental revenue. Remember the concept of relevant cash flows. So we are looking at incremental revenue. So let us say incremental. All right, so incremental, we start at 5,000. Okay, and then 5,000 to 11,000, we are having all right, in the first year we required 5,000. We required working capital equivalent to 10% of 5,000. All right, but we can see there that in the second year the revenue increased. Therefore, we also have to know that our working capital requirement will also have to increase. Okay, so it is going to be that increase that is going to apply. So the increase here is 11,000 minus 5,000. So it's equal to this one minus this one. That's 6,000. That's the incremental part. Okay. So our working capital here is going to be 10% of those amounts. So WC at 10%. So it is 10% of this amount. All right. For year 3, let us finish the incremental section first. In year 3, we can see that the sales have decreased. All right. The sales have decreased, and that decrease is going to impact on our cash flow requirement. Okay, so let me just take you a bit. All right. All right. There's a need for us to at least format a bit here. All right. We are saying here the working capital should be based on incremental values. All right, and the distance. I mean the difference between the year's revenues is going to impact on or the movement of the year's revenue is going to impact on the working capital, the ultimate working capital that has to be required. So in the first year we made revenue of 5,000, okay, and in the second year we made revenue of 11,000, and I said that for the first year we needed I mean we are going to use the 5,000 as the base figure for our working capital, okay, and our percentage is going to be based on that 5,000. However, in year 2 we are only going to have this figure, okay. This figure is going to be the difference, okay, between this figure and this figure. All right, that's 6,000. Then this figure is going to be the difference between this figure. All right, let me put an equal sign. This figure minus this figure. That's 3,000. But you can see that this figure is negative. The reason why it is negative is because the revenue has decreased. All right, the revenue has decreased. But don't worry, we need it as a negative because it will tell us something. Don't worry. Then in the fourth year, our revenue had increased a little bit from 8,000 to 9,000. So the working capital requirement is going to be based on this figure minus this figure. So that's a positive 1,000. Okay, so let us compute our working capital. Now the ultimate working capital is, I said, is based on incremental cash flows. So we're going to say equal sign this figure multiplied by 10%, that is 0.1. All right, that's 500. Okay, so in the first year we need 500. So obviously if we drag, we must get our cash flows, okay, the working capital cash flows. All right, so you can see that this is what we are going to do. All right, but we know that by the end of the day the working capital is going to be recovered. So by the end of the year, the recovery is going to be done. Okay, the recovery is going to be all the working capital which we have used is going to come back to the business. But you can also see in year 3 that we did not use any cash, any working capital, but rather we saved. Okay, so the decrease in revenue actually was a saving to us. We did not use any cash working capital. We did not require any working capital. In other words, we saved. Okay, remember we did the cost saving aspect in our previous video on relevant costs. So it means that in this particular year, in year 3, where we had a negative working capital of 300, we did have a working capital cost saving. So the sum we are going to recover. Oh, what's going on? My machine is misbehaving. It's now sticking. So the ultimate recovery is 900. So let us now take these figures to our computations. Right, so allow me to do this formatting. It's important. Okay, now we take the figures to our workings, and I said working capital, you can tell the examiner that this is in working 1 so that they see. All right, so according to our this column, ladies and gentlemen, this is sorry, that's the column I'm referring to. Okay, according to the shaded column, you can see that in year 1 the working capital requirement is negative, okay, 500. And then in year 2, that's negative 600. Year 3, it becomes positive because we had a saving, and then negative 100. Okay, and then after we do this, we then have to rule out everything and come to the net cash flows. Net cash flows. And as usual, our net cash flows are just an issue of adding up things. All right, so here we are having negative 15,000. All right, sorry. Okay, negative 15,000. All right, okay, for the commas you can as well come to our formatting here. All right, and then if you don't want those other zeros, you simply just have to remove them. All right, then here you say equal sign, you just do the additions. Okay, here you can as well just drag. All right, and everything has been done for you. All right, and let us just try to rule off everything. So ladies and gentlemen, those were our cash flows. Okay, let me see. Okay, I think we made some errors somewhere here. Just an error, and it's a very drastic and terrible one. All right, the working capital is required at the start of each year. All right, at the start of each year, which means at the start of the project's life, we need the working capital requirement. So in this case, we need to adjust a bit our figures. I'm sorry for that. Okay, I'm sorry for that. I accept the responsibility. Okay, I accept the responsibility there. All right, because the working capital is required at the start of the year, and this actually means that we also need the recovery that is going to be in year 4 at the end. The recovery, we calculated it here. This is the figure, the recovery of 900. So we need to slot it there. So this, ladies and gentlemen, should be so in this case here we need to adjust to sum this figure, that figure, sorry, equals sign sum open bracket this figure, that figure, and press enter. Okay, that's the thing, ladies and gentlemen. That's our computation. You can even bolden this last row for the examiners to make it easier for the markers to see your answer clearly. Okay, so those are the net cash flows, and we are done. Let us now talk of the aspects of taxation in our next video. Thank you. Okay, hang on. Okay, in as much as we did the corrections, it also means that because the working capital is required at the start of the year, therefore the first working capital requirement should be in year 0. Here it should be year 1, year 2, year 3, and the recovery of the working capital is going to be done in year 4. All right. Okay, so the recovery is going to be done in year 4. All right, so that is it, ladies and gentlemen. Please bear with me for that error, and I hope it did not cause much harm on your part, my favorite people. Thank you very much. May the good Lord continue to bless you. Thank you. Bye.